Hello, everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the non-farm payrolls and the opportunities its publication will present. My name is Sasha, and I'm a financial analyst from the research department here at Fortrade. Delighted to have you with us, and thanks for your comments. If you have any questions, I'll do my best to answer them, or please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, we would like to present our new offer that is exclusive to those watching this webinar. A special code will appear on your screen during the webinar, and I will repeat the special code at the end of this webinar that you can use to take advantage of our special offer. Be aware that this offer will expire in 24 hours and that this new offer applies to all of you, not just second-time depositors. So please stick around. It will be well worth it. If you make a deposit within the next 24 hours, you can receive a balance bonus. If you deposit €1,000, you will receive a 2% balance bonus. Deposit €2,500 and you'll receive a 4% balance bonus. Deposit €5,000 and receive a 5% balance bonus. Deposit from $5,001 to $15,000 and your overnight interest rate will be covered for 1 month. Deposit $15,001 to $25,000 and your overnight interest rate will be covered for 2 months. Deposit more than $25,000 and your interest rate will be covered for 3 months. You are, of course, free to use this bonus however you choose, but you might find it useful to know about our market opportunities. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by us at the research department on a daily basis, according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point, support and resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. So this is an example of a market opportunity if you haven't seen one. Here you can see fundamental analysis on what's going on with the pound-dollar currency pair. Below you can see some geopolitical events that can influence the currency pair. It's important to look at the pivot point on which the calculations are based. If the price reaches this level that you can see on the screen, this shows the right moment in our estimate to come in and open a trading position if you decide to trade on this market opportunity. You can see that this is a weekly market opportunity, although we also have regular daily trading opportunities. You can see the trend direction here, which is up. It's important that you know how to use the stop loss and take profit options. You have support and resistance levels here. At these points, you can put a stop loss and take profit. And further down, you have calculations. If you close the position using take profit, you can expect these kinds of profits. If the price is going against you, then you can potentially have a loss of this amount. Support 1, 2, and 3. The pivot point is the starting price for opening a trading position based on which resistance and support levels are calculated. The support and resistance levels here are for daily, weekly, or monthly terms. Finally, profit and loss calculations are based on a one-lot trading volume. So why is the NFP so important for the financial markets? Well, the NFP is the release of data on the US job growth over the previous month, and it's published by the Bureau of Labor Statistics, usually on the first Friday of the month following the data. It's the most eagerly awaited monthly data by world markets. Morning trading volumes are usually slim in European markets on the day of the release, as they await the afternoon release time. The headline number in the report gives the number of jobs that the US economy has gained or lost over the previous month. A more important number for the markets, however, is the difference between the actual change and the consensus of estimates by analysts and economists published in advance. The market reaction will depend on whether the published figure is above or below the consensus, and by how much. Over the past few years, non-farm payroll data has been very positive, but NFP estimates have failed to meet expectations more than 6 times over the past year. Last month's figures were above expectations, as I will explain in a moment. As you can see, the unemployment rate has significantly improved in recent years. The unemployment rate approached 8.5% during the financial crisis, but has fallen since. Since March 2017, the unemployment rate has dropped from 4.5% to its current rate of 3.9%. That's the lowest amount unemployed since 2000. Average hourly earnings is very important, since an increase in the figures indicates a possible rise in inflation and in the value of the dollar, while a decrease in AHE tends to push the dollar down. Month on month, average hourly earnings were 0.1% in April, as you can see on the graph. The NFP release comes together with the unemployment rate indicator on the first Friday of every month. When this is due, the trading week is a range-bound one for the forex market, and after release, traders start positioning for the next time the Fed meets to see how monetary policy changes in the meantime and how to react. When the actual number differs from the forecasted one, the market travels. Usually, traders try to take positions for the NFP in advance by looking for clues from other economic data, like the ADP jobs report or private payrolls. It's believed that private payrolls and the NFP data are linked in a directly correlated fashion, but this isn't always the case. The unemployment rate is part of the Fed's decision-making process to move on rates too. As a rule of thumb, a lower unemployment rate is better for the economy, as jobs are created, and this could result in the Fed hiking rates. Higher rates lead to a higher dollar. There isn't such thing as full unemployment in an economy. By the time the unemployment rate has fallen to below 4%, a labor shortage has already appeared, which experienced traders know. Forex trading is about anticipating what the central bank is going to do with interest rates at the next meeting, and the NFP is the perfect economic release to position on the right side of the market. So, the non-farm payrolls released on May the 4th, 2018 showed that the US economy created 164,000 new jobs. That's less than a predicted estimate of 189,000 jobs. The jobless rate declined to 3.9%. That's lower or better than the expected figure of 4%. Upon the release of the report, the US dollar index fell by 0.52% following the publication. On the graph in front of you, you can see the reaction of the market upon the release of last month's NFP report. Or I should say on this month's NFP report, but the last NFP report on May the 4th. As already discussed, the unemployment rate was lower than expected, and the NFP was also lower than expected. But lower than expected average hourly earnings and only 0.1% was also below expectations. So why, as we can see on the following graphs, did the dollar grow higher? And here is the euro dollar. It's a classic pattern in trading on the NFP for the dollar to lose value as it absorbs initial information regarding a lower than expected average hourly earnings. But on some occasions when unemployment is lower than expected, pushing up inflation in the medium term, then the market tends to buy the dollar, pushing it up in value. On the dollar index graph that we had in front of us a moment ago, we can see that upon the NFP release, the dollar first dropped in value. Then it climbed by 0.61% against a basket of currencies. As we can see with the euro dollar, there was volatility during and after release, and the pattern is the same as with the dollar index. The euro-dollar grew in the moments following the release and then dropped as the markets absorbed lower unemployment figures, and the currency pair fell by 0.5% over the next hour. The thing to remember is that the dollar is often volatile during the NFP, even more so because of geopolitical factors such as a potential trade war, as is the case at the moment. But the NFP can also represent a trading opportunity. Economists expect that the NFP will record that 188,000 new jobs were created in May, and that the unemployment rate will remain at 3.9%. Traders will be well advised to keep an eye on the average hourly earnings figures. If they are above expectations, it may cause the dollar to continue its upward trend. Average hourly earnings are considered a sign that inflation will rise, and if inflation rises, there is a greater chance of interest rate hikes. Some economists have already speculated there may be 4 interest rate hikes this year, rather than the anticipated 3. It's worth noting that the Fed decided to increase its interest rate by 0.5% to 1.5 to 1.75% at their meeting in March. If you'd like further analysis on that, we'll be holding a webinar on the Fed on June the 11th. What is certain is that reports like the NFP can have a major influence on the financial markets. In case you missed the promo code during the presentation, this is your opportunity to take advantage of our special offer, which will last for 24 hours. The promo code is FTD1X. And of course, it's up to you how to decide to use this offer. So that's all we have for you today. I hope you've enjoyed this webinar, and please join us at 4Trade again soon.